Hello, everyone. Welcome to the weekly roundup. Today, we'll cover updates on geopolitics, foreign currency, and earnings releases. Hello, Ben.
Hi, Eva.
How's it going?
It's going good.
Seems like a nice enough day today.
Pretty nice, actually. A little bit warmer, like -5, -6, like sunny. It's good.
Okay, but I hear we're expecting something not so nice on Friday, tomorrow.
Are we? Snow?
Yeah,
Oh my
yeah.
gosh.
The
I didn't see it.
weather, like -30, we're gonna hit -30.
Oh, that's perfect.
Can't wait.
Yeah, exactly.
Okay, we're going to start off again with geopolitics um, and the idea of a shifting global order. If markets are entering this new regime, what are the most likely scenarios over the next 3 to 6 months? Maybe you can take us back a bit. I know this week was interesting.
Yeah, for sure. That's great. No, I think that's a great jumping off point. Certainly, we had an interesting week, and I think as you read and follow more, it's hard to discern what is AI and what is legitimate. So I think that's one. As for the change in the global landscape, I think that probably Carney has been saying it best the last few weeks, really, with the trip to China and effectively saying in his speech at the end with Xi was that it's a new world order and we need to adapt. And so, I think if you listen to a lot of the World Economic Forum, which happened in Davos the last couple of days, there was a lot of that talk around, excuse me, what's happening and all those changes. Um, Many of the leaders effectively are echoing, we're not just going to blindly follow the United States anymore. And that is a big sentiment shift, and likely going to be quite disruptive globally. I think one of the things I think about and spend the most time on is, when does the US lose reserve currency status? Because that's probably the key linchpin for this world order to completely shift. And that cycle happens over a long period of time, and the US has been dominant for a long time. And I think that a lot of the things that are happening right now are pointing in the direction that we'll have a different reserve currency. And we've talked about it a little bit on and off over the years, just similar to this SDR, which is like a global basket. How's it going to be administered? Who's going to be in it? Listen, I think the US dollar doesn't disappear from reserve status, but I don't think they have the hegemony that they have now. So that will have material impacts and ripple effects. So I think part of what you see Trump doing is maybe a bit of more of a mastermind than you think from the perspective is he acknowledges this. And so he's going to be as aggressive as possible at acquiring things that'll help him. And that was with the attack, we'll say the verbal attack on potentially taking Greenland. Obviously, we've heard about Venezuela and we know that's happening, and that's still a piece that is very important. We need to continue to pay attention to and not get totally distracted. But the attention back to Greenland, he talked about this Golden Dome. Seems like he's walking back his comments a lot. And Golden Dome is effectively how do we protect the US from attacks effectively is what he's trying to achieve. And that's been his argument for why he needs to acquire Greenland. One of the things I saw was there's been information leaked that he may buy Greenland, like give the Danish government $600 billion plus every citizen $100,000 US to buy it. And so, listen, I don't think that's going to happen. But if you see your currency is devaluing and has a risk of being less important today than tomorrow, that's actually a reasonable tactical decision to do that. So, but he's walked back his comments. Seems like they've had negotiations. Ultimately, he probably wants to increase his footprint, like the military base in the north of Greenland. Um, I'm not sure why they would give him mineral rights. but he seems to be indicating that they would do that. So I think one thing that's really happened when you listen to some of the speakers at the World Economic Forum, we had the leader of Finland speak yesterday and talked about his comments on what's happened between Russia and Ukraine, which I thought was an interesting piece. Just talking about how, Russia has been attacking. They've taken 20% of the Ukraine land, but then went on to list all of the casualties. Inflation in Russia right now is about 16%. GDP is non-existent. Like they're in a continual recession, and what that's done is it's really forced the Europeans together. And so what Europe has done is said, okay, we can't rely on your natural gas anymore, so we're going to go try to find it from somewhere else. Canada's a potential benefactor of that. And they also said we're going to increase military spending. So then US comes the other way and says, yes, we're going to take Greenland. What's that do? Pushes Europe more together and
Yeah.
says it's more important. So it's a long-winded answer to your question, but a lot of the things that are happening are really positives for other areas of the world and quite negatives for the US and Russia, I think, in this instance.
Okay.
Yeah.
Still around the US dollar, with the PCE CPI mix, possible rate cut expectations, and growing questions about the Fed's independence. How vulnerable is the US dollar, and what could a materially weaker greenback mean for global risk assets?
Yeah, so it's a great question. I think the what could happen to the US dollar. So if they have any, I don't think they're going to have any issues with raising capital because
Yeah.
the central bank is the buyer of last resort, just like every central bank in the world. Canadian government needs to issue debt. If there's no buyers, the central bank buys it. US government needs to issue debt when they need to issue 8 to 10 trillion dollars of debt this year, the US. If there's no buyers, and there's not going to be buyers for $10 trillion of debt, the US central bank's going to buy that. So I think the risk is how that plays out, how their debt raises go, what do they do, how are they going to manage that? And that kind of piggybacks onto your question about the central bank independence. Um, I don't think it exists anywhere globally, because it seems like the central banks have followed Japanese policy, which is if there's no buyers, then we buy it. So, are they truly independent if they're doing that? Well, I guess you can make an argument for that, but I don't think that they're super independent that way. But as for what's going to potentially happen in the U.S., to your point, with a new Fed chair coming in May this year, I think there's no doubt it's going to be someone that's friendly to Trump, and likely means rates probably come down fast or faster, depending on what's happening to the world and economy at that time. We're still 4 months away from that. What's transpired in the last 22 days already is incredible. So we got lots of ground to cover till we get there. But the further diminishing of the independence, I think, will continue under the new leadership.
Yeah.
And I think they will do what they can to flatten rates. So that probably means buying the long end of the curve, to try to reduce pressure on the US consumer. And you had one more question in there is what does this mean for risk assets internationally? If we get a weakening US dollar, historically, that's been extremely bullish for international emerging markets. So I'd say positive from that perspective, with quite a positive spin on potentially China's future.
Okay. So earnings season continues. Any, results we should be focused on in this reporting cycle?
Hmm. Yeah, so far quite a bit have come out in the US, more in earnest in Canada next week. But we've seen Netflix and Intel and some of the banks. A lot of them I'd say are in line. Like Netflix came in. ahead of expectation, but reduced guidance. So stocks down on that. Intel came in with relatively positive news. Their stock's been up most of the year. In fact, they're probably up 60% in the last 3, 4 months. So Intel's had a real positive change. The banks, I think there's certainly some concern about what happens from here. And I'd say there looks like they're a bit priced for perfection. So I don't know from an upside perspective what happens there. However, that being said, if liquidity does take off middle of this year, I think that'd be quite positive for the banks again, but I think sideways to neutral so far. So earnings generally mixed. If you have a small miss, definitely the market kicks you in the teeth right now.
Brutal.
Yes.
Okay, let's see the charts.
All set?
Yes.
Okay, perfect. So we are recording this on Thursday, January 22nd, around 1 o'clock. So anything that happens between now and next week, we'll comment on there. Of course, we got central bank in both Canada and the US coming up next week, which we'll talk about in a few minutes. So that'll be important to look at. So let's start it off with this. Canada annual home sales variation in December. And so, we try to comment on home sales here on and off. I think it's very important for Canadians and get lots of questions, conversations, a lot to do with what's happening in the rate cycle and also what's going on in housing. I thought this chart really jumped out at me just to see the difference in home prices, PEI to Quebec. And so PEI at the left being the best, and Quebec at the far right being the worst. So I think you've seen a real different housing market in the past, we'll say probably 30 months. And this last recording for December was quite interesting just to see, how soft Quebec, Alberta, BC have been. I think that'll be important to pay attention to. Some of this will flow through to the financials earnings as well. So I think it's important just to think about that. They do offload a lot of their mortgages with the to CMHC and such, and repackage them. But I thought this was an interesting chart just to see the massive divergence in the housing markets. And you have one of the slides I'd put up, I think, last week or the week before, just to see the amount of people moving out of the big cities. This is a great framework just to think about and reference that. You get a lot of people moving to other markets, the smaller markets at this point. So this is something I learned maybe 10 years ago, which I thought was quite interesting, just when you think about the world, that the economy and the stock market are connected, and in particularly in the developed markets, it's even more connected than anywhere else. Where there's lots of conversations over the last couple of decades just around emerging markets and how are they important and what if they go up and down and so on and so forth. But they are nowhere nearly as important as the US and Canadian stock markets were as a result of the impacts they can have on GDP and we'll say individuals. And so this stock says stock and investment fund shares as a percentage of nominal GDP. And so I think it's great to look at from 1990 to here. The dark bars, of course, are recession periods, and it just shows you the severity and how this can come down. Well, I know the flag, particularly on this chart, is around the US. I say Canada is just as exposed from that perspective. We just haven't taken off as much because of a little bit less tech IT exposure. But the stock market is incredibly relevant to what happens to GDP, particularly in North America, similar in Europe, but particularly in North America. And I think we need to be conscious of this. From the point is, if we get a correction, do we get a recession, or do we get a recession and then we get a correction? These things are connected, and I think important to think about from where the potential risks are in portfolios as we drive forward. Next slide, S&P 500 dividend yield. And while you can look at this in many ways, I obviously look at it from a perspective of probably the inverse of this, right? So if you look at these tops typically are stock market bottoms, and these bottoms are stock market tops. And so I think it's relevant to think about this. So if you look at here, early 90s here, we got up to a dividend yield 3.87. We bottomed around 2000, makes sense. That's when we had the big tech rally. So the market had gone up, so yields had fallen. So and then as we kind of fast forward out to 2008, which was the housing crisis, again, we got a peak into the end of 2008, early 2009, 3.42, which coincided with the bottom, of course, of the S&P. And now that we start to reach these levels again, we're around 115. It's not one signal. And so often I get, what should I be watching? And my answer always is there's many things to watch, but what should I watch? I'd say this is an important factor to think about from a valuations perspective. Is this time truly different or is it not? And so I know the last couple of weeks I told you to pay attention to the US 10-year yield. I think that's still an important gauge to be conscious of. But this is another signal, great chart from Charlie, just showing that we're getting low yields. As you get to that one, below one, you're starting to show valuations quite stretched on the top end. So as always, the opinions expressed in here don't necessarily reflect those of National Bank Financial. Everyone's risk and tolerance is different. Everyone's needs are different. Should you have any questions or comments about anything we discuss, either in the charts or here, please feel free to reach out to Eva or I, and happy to discuss and provide more feedback that's directly relevant to you.
Okay. Thank you, Ben.
Welcome.
What are we looking out for next week?
Yeah, so certainly central banks, both Canada and the US, are meeting on Wednesday next week. So we don't think that there'll be any action, but stay tuned. We'll see. There are still a few days between here and then that could change those things. But so we'll watch that on Wednesday. Bank of Canada out in the morning on Wednesday, and the US Central Bank out in the afternoon. We've talked about positioning the last little while, and one of the things that I've commented on fairly frequently, which is gold and metals, and materially reduced some of that today. Been trimming over the last probably 12 to 15 months, but in earnest sold and reduced precious metals exposure to the individual securities. Still keeping exposure to the commodity itself, but dramatically reducing that based on the run that we've had. So I'll be monitoring that quite closely. And, it's one of those things that, you want to participate as much as you can in the upside, but also have to be relevant, or have to be important to think about some of the downside risks, and reducing that into a volatile period, I think makes a lot of sense. I know you'd asked me earlier before in our conversation today, like what's the trigger that could cause this to switch, and I think that trigger is some potential good news. And so, there's been lots of noise and negativity. If we get some good news, we could see a spike in oil and likely some downside in metals. We saw natural gas rally pretty hard this week as well, so I'd be watching that. So I think it's some good news maybe coming.
Okay, I hope so. Very optimistic.
Yes.
Okay, thank you. Just a reminder that our annual outlook for 2026 is next Thursday at 12:30 p.m. I will share the link by the end of today or tomorrow morning. Please visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video on YouTube and in your inbox if you're subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and have a good weekend. Stay warm. Bye.
Thanks. Take care. Bye.